Hello class, and welcome to the video lecture for Accounting for Merchandise Inventory. Learning Unit 1 introduces the perpetual inventory system and describes the difference between perpetual and periodic systems. First, I'd like to describe the characteristics of a perpetual system and the general ledger accounts used. When a business uses a perpetual inventory system, the cost of merchandise sold is recorded at the time of sale. Now, what do we mean by the cost of merchandise? The cost of merchandise is the cost to the business to purchase merchandise that it intends on reselling for a higher price. It is not the retail cost. The retail cost, is the price to you as a consumer to pay for the merchandise. So let's review the example in the textbook, which starts on page 553. On June 2nd, the business purchased 10 packages of AIB software at a cost of $25 per package for a total of $250 on account. Remember what on account means. It means the business used credit to purchase the merchandise and did not pay cash. When using a perpetual system, the business records a transaction with a debit to merchandise inventory and a credit to accounts payable. The next transaction, on June 3rd, the business sold 3 software packages for cash to a customer at $50 each for a total of $150. When using a perpetual system, 2 journal entries are needed every time a sale is made. One is to record the sale to the customer, and the other is to record the reduction in merchandise inventory. The first entry, the sale to the customer, is based on the retail sales price to the customer. It's very important when analyzing these transactions to determine which is the cost to the business and which is the price to the customer. In this case, the business sold 3 packages for a total of $150, so we debit cash and credit sales. The second entry is to record the merchandise that's been sold. Recall cost of goods sold from Accounting 110. Cost of goods sold is the cost to the business of the merchandise the business purchases to resell to customers. In this case, the cost of a software package is $25. Since the business sold 3 packages, the total cost of goods associated with this particular sale is $75. We record this transaction as a debit to cost of goods sold and a credit to merchandise inventory. Remember that merchandise inventory is an asset account, and how do we reduce asset accounts? With a credit. Now let's look at what happens if the customer returns one of the packages. On June 5th, the business allowed the customer to return one package for a cash refund of $50. As with sales transactions, returns of merchandise are also recorded using 2 entries. One to record the refund to the customer, and another to put the merchandise back in the merchandise inventory account. Remember that we don't debit the sales income account to record a reduction in sales. Instead, we debit a contra revenue account called Sales, Returns, and Allowances. This makes it easier for the business to track the items being returned, which allows the business to more effectively evaluate its sales. For the second entry, we simply reverse what we entered in the original sale. We debit merchandise inventory and credit cost of goods sold. Now, what would happen if the software didn't work? We don't really want to put it back in our inventory for resale, do we? So this doesn't change the previous entry. We still return it to merchandise inventory, but then we contact the vendor and arrange for a refund. A vendor is what a business calls a company the business purchases merchandise from. Keep in mind we haven't paid the bill yet. We recorded an account payable back on June 2nd. So to record the return to the manufacturer or the vendor, we reduce this accounts payable with a debit for the cost of the merchandise, which was $25, and credit merchandise inventory because we're taking it back out of inventory and sending it back to the vendor. Now I'd like to do a problem from the textbook. Let's do exercise 15B-1 on page 580. It says the Lane Electric Company uses the perpetual inventory system and we are to record the transactions. On February 3rd, purchased 55 model 77DX light fixtures on account from Hotwire Electric at a total cost of $2,200, terms net 30. Recall from Accounting 110 what N/30 means. It means the bill is due in 30 days. So let's record this purchase of merchandise. We have a debit to merchandise inventory. I'm just abbreviating merchandise here, of $2,200. And since we're buying this on credit, we don't have to pay the bill for 30 days. We credit accounts payable. For $2,200. Okay, so on February 5th, sold 10 model U67 light fixtures for cash for $280 total. The cost of these 10 fixtures amounted to $180. These are not the same light fixtures we just purchased, but we have all the information we need to record the transaction. So this is a sale, and since we use the perpetual inventory system, we need two journal entries, one to record the sale and one to record the reduction of merchandise inventory. So we sold the fixtures to the customer for $280 cash, so we debit cash and credit sales for $280. Now we record the reduction in merchandise inventory. So the cost of these goods is given in the problem as $180. So we debit cost of goods sold, $180, and we credit merchandise inventory. Okay, so excuse me, on February 6th, our customer returned 5 model U67 light fixtures. We gave the customer a $140 cash refund. This is a return, so again we need two journal entries, one to record the refund to the customer and one to record putting the light fixtures back into inventory. So we debit not sales, we debit sales, returns, and allowances. I'm just going to abbreviate this here. For $140, and we credit cash, which is the money we're giving back to the customer, $140. So next we record the increase in merchandise inventory, but how much? It's not the $140 we gave the customer. We have to figure out what the cost of those 5 light fixtures was to the business. So let's look at the previous transaction, and it said 10 fixtures cost $180. That means one fixture is $18. If one fixture is $18, 5 fixtures would be 18 times 5, $90. Okay, so we increase merchandise inventory with a debit for $90, and we credit cost of goods sold. On February 10th, We issued a debit memo for $320 to Hotwire Electric for 8 Model 77DX light fixtures that came in damaged in the shipment of February 3rd. Remember that we ordered these light fixtures on account, so we haven't paid for them yet. We don't get a cash refund. Instead, we create a formal document called a debit memo saying we're returning the 8 broken light fixtures and reducing our accounts payable by $320. So to reduce our accounts payable, we debit the accounts payable by $320 to record a reduction in the liability. And then we record a reduction in the merchandise inventory with a credit of the same amount, $320. Okay, so that wraps up Learning Unit 1. In Learning Unit 2, we'll briefly cover subsidiary ledgers for inventory.